The topic today is a bit of a technical one, but one that gives rise to a lot of questions to our support team. So I was hoping to do one webinar to explain these and also post out the recording for whenever those happen. So let's get going with it. The question is how MT4 links with the market. And there's more to that sentence than you could imagine. So let's get going. Well, you know this. This is the end of MT4 that you guys see, the MT4 terminal installed on your local computer. And in it, you can see the market price. So it becomes so familiar that few people actually question how that price comes about and at what price you're trading. And today, that's one of the things we'll be discussing. Because as I said, it's a complex thing that's going on behind, and it helps to understand it because when there are things like slippage or news releases, this is the kind of stuff that explains why all that goes on. So the core considerations of what we will be discussing today is in MT4, the MT4 platform, out of the box is designed to be a dealing platform. I'll explain what that means. Essentially, it means that it wasn't designed to hook up to the actual market, but it was more of you can really think of it this way, as a gambling platform where the dealer quotes a price and then you kind of take the bet against it or not. But the bet wasn't really placed in the interbank market up until technology allowed that, after MT4 was invented, in which case it becomes an STP platform in brokers like DarwinX. Then we'll get to the consideration of price versus order-driven matching, and I'll explain what that means in a second. That's actually quite an interesting consideration. And last but not least, the other point is whether you're acting as a liquidity taker or a liquidity provider. And the MT4, for reasons that I explain later, only allows you to be a liquidity taker. You cannot provide liquidity to the market. And I'll explain what that means too. I appreciate these are reasonably complex topics, and I haven't really explained them anywhere near the level that you would want it. We'll get into that in a second, but as I said, if you have any questions, stop me there and there, and I'll try to clarify. So, on the topic of dealing versus STP mode. So, out of the box, MT4 is a so-called closed loop platform, which means that, as we'll see in a second, that whenever you take a trade, whenever you guys go long the euro dollar, if you were trading with a dealer, then the dealer would go short the euro dollar, and basically you would both be opposite sides to a bet, where if the euro dollar went your way, you would win and the dealer would lose, and the other way around if it was the contrary. That's the default mode that MT4 can operate on, called dealing mode, and as opposed to the STP mode, which we'll explain later. But before that, let me explain in detail how the dealing mode works. Well, on the one hand, you have the so-called market. You can, and this would be typically the biggest interbank, the biggest banks in the world exchanging spot foreign exchange with each other. And there are electronic aggregators that track at what prices that exchange is taking place, and that's how the market price, so to say, comes about. That is an input for the MT4 dealer to decide which prices to deal at. So in this case, for instance, whenever you see a price in the MT4, that would be the price that the dealer has decided to stream, as informed by the OTC price feeds. And as I discussed just a second ago, whenever you hit, and I hope you guys can see my MT4, my mouse over here, whenever you buy the euro dollar, then that is traveling through the internet to our MT4 server, and in that situation, the platform will take the opposite side, and that way you have closed the trade. But crucially, it never really reaches the market, so it's never really placed with the market, but rather the market is being used as an information as to at what level that price should be closed. And what really has gone on here is an over-the-counter contract between the dealer and yourselves in this setup. Now, this can lead to issues. The first one is that, as we said, this essentially is a bet where either the dealer or you win, but unfortunately it's open to abuse because it's not an impartial referee who's quoting the prices, but rather it's actually the dealer who's choosing them. So the dealer, nothing stops the dealer from basically saying that the euro dollar wasn't trading where it is now, but essentially 1 pip higher, because that maybe suited them. So it's open to abuse in dealing mode. Then, very importantly, if you have limit orders, so if you have placed, say, a stop loss, then the stop loss will be stored on the MT4 server, which means the dealer has access to see where that stop loss is. And theoretically or technically, nothing would stop him from stop hunting by quoting a market price designed to trigger that stop, and then for that market price to then rebound to a more favorable level than when you were, which would mean you would have locked in the loss, and he would have pocketed that loss from you. So that would be open to abuse. And then, of course, there's requotes in setups where the market price has moved from the time where you click the button until it has reached the server to a level which is unfavorable to the dealer. So you kind of have a locked-in profit in there. And at that situation, he could choose to requote, which is essentially to choose not to fill you at the originally advertised price, but to offer you a worse price, which may not be of interest to you anymore at that point. So those are the issues with the MT4 closed loop. If we go back, so we've explained this bit, which is, for instance, what DarwinX never does. So we're not dealing mode, we're 100% on STP mode, but just so you understand how that works, because MT4 out of the box can only handle dealing mode. That's the standard way in which MT4 works. And then I guess towards close to 2010, then the first piece of software was invented that really did connect the MT4 server with the interbank FX market. So, and that's how DMA brokers like DarwinX were born. So DMA means direct market access. And basically what's going on here, it's whenever you go long the euro dollar, then DarwinX goes short the euro dollar because we are your counterparty. But at the same time, we go long the euro dollar with the market, with, say, the likes of UBS, Deutsche Bank, and a whole bunch of other banks. Which basically means that it's no longer you trading against your broker, which would be us here. It's you against the interbank market, with us in the middle as an intermediary with aligned incentives. In this situation, if you are short the euro dollar, then we are short the euro dollar with you. And there's nothing for us to be gained by movements in the euro dollar one way or the other, because in that situation, we are a broker, a full intermediary. And this was achieved by a piece of software called an MT4 bridge, which essentially takes in the incoming trades from the MT4 terminal into the MT4 server, sends them onwards to liquidity providers, and waits for the confirmation that it then fills at this price. So it's a longer time that takes place because there's an additional process here for the MT4 server to trade with the market. Understood so far? Any questions? Right, okay, well that kind of changes the game in good and perhaps less good ways. So the good way is that the incentives of a broker are strictly for customers to win. So DarwinX only wants customers to win, because the more you win, the longer you stay with us and the more volume you do in the long run. So given a choice, we want you to win, not the market. Whereas if we were a dealer, then the opposite would be true. We would, obviously, dealers also want traders to trade for the long term, but they profit from the losses, which doesn't align them so well with customer profits as being a broker does. Is this understood? I mean, this is one question that I get all the time. Like 99% of so-called Forex brokers are not brokers. They are broker dealers or dealers. So a dealer would be one which never sends the trades to the market, such as here. So in this situation, the trades never reach the market. This would be a pure dealer. And then the most typical model is one where there are broker dealers. So the brokers choose to internalize some of the flow to bet against some of the customers. This would be the left hand of the equation. And they then also choose to, or they may also choose, particularly with traders who win consistently, to route that volume to the market. Okay. So we discussed that, and then we come to the second point. So we've discussed the dealing mode versus STP mode of MT4, and now we get to another interesting question, and that is what price is it that's offered when MT4 is on STP mode? Well, what I've got here is a snapshot of the spread with our liquidity providers. So you can see, for instance, for the euro dollar, for the different levels of market depth, the bid and the ask. In some situations, it can be that the spread is negative because the bid is higher than the ask, which is obviously a nice opportunity to trade at no cost. But the important point is, as you go down, the spread widens. So you see a spread which is initially of minus 0.5 for top of book. And then as you go down, and if you want to place bigger tickets, then you see that you see the market depth in aggregate here. So initially there would be 1 million at this level. There would be a cumulative 3 million at this level, a cumulative 4 million, which is 1 plus 2 plus 1 at that level, then 4.5 up to 0.6, and then and so on and so forth. The important point here is that it's not one price. So this is one price, but there's also like 15 other prices in here. So what is the price that's displayed at MT4? That's the question. And this is an important question because at MT4 clears on a price-driven basis. So you send an order for a price, and then you either get filled or you don't. But the actual market, what you do is you send an order for a volume as a limit order. You say, I'm willing to trade, if I was on the bid side, I'm willing to trade 1 million at 1.09737. And if someone is willing to meet me on the ask side, then the trade clears and is matched on the order side, which are two fundamentally different ways to do this process. And the important point is that the OTC market works like this on the basis of orders, but the MT4 only works on the basis of price. You don't really see, on the standard MT4, you don't see the market depth, as you would see here. If you want to see an example of the live market depth, I'm just going to show you one. So this would be the euro dollar. Let's just go for the euro dollar. This is the live example. You see basically people feeding in on the bid and on the ask, and you see what the levels are. And you can also see the volume weighted average prices, which is what we've got here, which shows you the price at the top of book, which is where the best available price, and what happens if you try to place bigger trades. So, for instance, this would be 500K would be 5 lots, 10 lots, and so on and so forth. And you can see that for, say, 1 million or 10 lots, the volume weighted average spread right now would be 0.3. There's a lot of market depth because you can see you can place quite a bit within 0.3 right now. If you wanted to place a ticket for 10 million, then the spread would be on average 0.4 for all that, which would start by being quite favorable in the first top of book. And then as you draw down in the order book, the price is gradually getting worse and worse. Now, importantly, MT4 has no way to convey this information because it's only showing you the top of book. So that's the important and relevant consideration for traders, particularly if you're looking to raise investor money the way we actually already allow for in Darwin-X. What does this mean? Well, first of all, there's the topic of slippage. So if you are trading on an STP broker, then you are going to get slipped for sure. Doesn't mean you're going to get slipped negatively, but the price may not always be what you expect it to be, precisely for the reasons you see here. You see the price is moving all the time, and that's what happens. I'll explain why that happens in a second. Then there's another very important issue, and that's that limit orders. So, for instance, if you want to place a stop loss at a given price with MT4, then the way MT4 handles that is it's not really a limit order, as I'll explain in a second. And last but not least, you should be aware that the market isn't always equally liquid. And if you trade at times like what seems now, it is very liquid because you see there's a lot of depth without the price moving. But if you go to situations where news are going to be released, then the bid and the ask are very thin on the ground, and the spreads can widen significantly and move a lot shortly. So at those situations, it can happen that, for instance, well, I'll explain later, but it can happen that a trade is triggered, like a movement triggers your stop loss, and the market moves your way, and you get filled at a better price than your take profit. Or conversely, the trade, the price triggers you take profit, but then the market moves against you before that trade gets filled, and you get filled at worse than your stop loss. And that doesn't mean that Darwinex is a bucket shop. It means that you're in the market and the markets move, not always the way you expect them to. So why does slippage happen? Well, it's a very simple complex. It's basically the prices that I'm seeing here have traveled through the internet until they reach my computer, and depending on where you are in the world and how many pings there are from the server until me, it could be up to 0.1 or 0.2 seconds that the market has moved. And then I would click on trade, I would send that trade back, and then, of course, it would take another 0.1 to 0.2 seconds until that order actually hits the liquidity providers. And in 0.2 to 0.4 seconds, the markets can move one way or the other. And that's why it's very unlikely that you get filled at the exact price that you hoped, that you saw on your MT4 at the moment that you clicked the button. Is that clear? So that's kind of the round trip internet latency. The other point is, of course, that what you see here is liquidity that's available for everyone to see. So it could be that someone was faster than you in getting to it, perhaps because they had a VPS, and they actually got the best ask available at that moment, so that you then get filled at the next available best ask, which isn't as good as the one that was advertised. And that doesn't mean that anyone's tricking you. It's just that's the way it is. First come, first served. If you're not there at the right time, then you don't really get filled. And this is a classic. So we get this a lot as well. So a lot of people come to us and say, "Hey, my previous broker, in my previous broker, I never had slippage." Now I'm going to show you, I would like to explain to you why that is not possible if you're a broker. So if you are a true broker, you're offering the fills at which the market is filling you, which means that we cannot hold constant the market price for those 0.4 seconds, because that would put us at a certain risk. So if we held the price at which you traded, say this level, then two things could happen. One, if the market moved your way, in which case, for us to keep that price that you saw in the terminal, we would incur into a loss by filling you at a price which was not available in the market, or which would be the case here. Or else, perhaps what would have happened is if you traded at a certain price and the market had moved your way, then we would actually be stealing from you, because there would be a profit that accrued to you that we would be profiting by holding the price constant. So we could not do that. We could not guarantee no slippage without incurring market risk ourselves. And if we did that, of course, what can happen is there's arbitrage opportunities. So there could be scalpers who could come and benefit from the fact that we offered a no slippage guarantee and make guaranteed money from us, which we can't do because we're a broker. So all this long story short to basically explain to you that if you are trading with a direct market access or STP broker, which is really routing your trades to the market, then slippage is part of the game. A different story is if you're talking about dealers, and dealers actually are very happy to engage in to offer the no slippage feed, because they know that most traders lose on a systematic basis, so it pays for them to offer seemingly very comfortable conditions. Basically, the water ball here, so it's very comfortable in here. There's no tempests or anything because you're not really in the real market, and the dealer is holding the environment very stable for you to make it, seemingly simple. But that's not what happens when you're in the real market, because in the real market, all sorts of things go on, and we cannot shield you from those because we don't have a balance sheet to protect you against that. All clear so far? We've got a question. That's correct. Slippage, in theory, is random. So if you're talking about orders that are not, in terms of the size of the order, if you look at orders that are up to 5 lots or 10 lots, as you can see here, then the size of the ticket is not a consideration, and then slippage should be random. It could be positive or negative. It should, on average, even out. Now, if you had a trade for up to, say, 10 million, then that's a different story, because you can see that the price for 10 million is systematically worse than the top of book. There's like a difference of 0.3, 0.4 currently, which means that if you traded 10 million on the MT4 and the top of book was what you were seeing on the MT4, then you would have systematically negative slippage. But it wouldn't be. That's because that's what happens. The market liquidity is finite, and then you have to accept the fact that when you're trading with 10 million, the prices are not going to be what you see at the top of book, because you're moving the market in a way. Right. So this is another. Thank you, Philippe, because this is a very good question. This is the next topic that we get onto. That's what happens with the limit orders, and this is what I wanted to explain here. Now, the way MT4 works. So you set a limit order, like a stop loss, okay, and you set it at a certain level. Now that stop loss is going to be stored on MT4 server. So you enter your stop loss on your terminal, that then travels to the MT4 server, and it's waiting there. And what happens then is that the MT4 server waits and only activates that limit order, that so-called limit order, which really isn't a limit order. It activates it when the price touches the level that you had at your stop loss. But at that point, what it does send is a market order. So let's say you have a stop loss at, you're in the market, the euro dollar is between 109.72 and 109.74, and you put a stop loss at 109.70. So the 109.70 would be waiting in the server until the price touched that level, they ask in this case. And if it did touch that level, then what you would send is it's a market order for the best price available then, which could be better or worse than your stop loss limit. So it is possible to have a negative slippage on a limit order on MT4. Is that understood? So you could set your stop loss at 109.72 and get filled at 109.67. That is possible. It's very extreme, but it is possible. And the reason is because you're not allowed to enter the order book directly. You cannot post an order here, which, let's say, so you could not enter at this level, at the 109.72. You cannot post it as a limit or as a true limit order the way you would in a stock exchange or in an organized marketplace, because MT4 is not designed to send limit orders. With MT4, you only send a trade for a certain volume at 109.72, but it's not really entering the order book. It's just it's basically waiting to be triggered when the price gets there. So with MT4, in other words, you can only be a liquidity taker, but you cannot be a liquidity provider. So is that understood? And that's basically the biggest issue that MT4 has when you're using it with a broker, in the sense that it's not ideal for these kind of setups. And that's one of the reasons, for instance, that we are developing a REST API that will allow you to become a liquidity provider. So in that setup, when you once that is ready, once you enter a limit order, a stop loss, it will be really treated as a limit order, because it will be entered in the order book and it will be there waiting in the queue. So whenever the price gets there, you'll be the next one to be filled. That's, I guess, possibly the most important point today. That's the biggest understanding that triggers the biggest questions for us. And then, have I managed to bring this one across? Because this is the most important topic today. So, like MT4 limit orders are not really limit orders when you're dealing with an STP broker, because MT4 out of the box cannot handle that. They are actually kind of conditionally triggered when the price is touched, and then so it's kind of triggered if touched order, not limit. Okay, then the other points that we get a lot, and which are also some news to some of our newer traders, there's the daily rollover, where the LPs roll positions over for the next day and they do their accounting. This happens typically, well, this always happens at 1700 New York time every day, it's kind of European night. And for about 5 minutes, you will see that the spreads widen significantly, because at those points the LPs do not want to be hit so that they can do the accounting properly from one day to the next. That's a convention that you will also face when you come to DarwinX. With us, you can trade at those times, but the spreads widen significantly, so it's really not advisable to be in the market at those points, and to set your stop losses and take profits accordingly. And then, of course, there's the news releases, and this is another one where we get a lot of abuse by people who think we're a bucket shop and so on. And really, the people who say that don't really understand that we as a broker are trading with our customers. So whenever any of you guys get filled on a bad price with DarwinX, it's because DarwinX has been filled at a bad price. So we are the first ones to get screwed, if you want it to be like that, from the LPs. And there's no incentive whatsoever for us to get screwed and then kind of get abuse from customers for that. And the situation there is that when there are news releases, like where there's non-farm payroll, the fact is the liquidity is extremely thin, which means whenever one order comes in one way or the other, so basically if there's a very little, very big differences, very big jumps in price for every unit of volume here, what can happen is if a bit of volume comes on one side, then the market moves a lot against that side, and vice versa, and the price gets very, very volatile, essentially because there's no liquidity, and that's how the market works. So, and because we're a broker and we get you the market liquidity that's available, whenever no liquidity is available, which is, the best price we can get you is shit. And in those situations, possibly the best idea is not to be in the market at all. Yeah, and that was pretty much it. I mean, this is a reasonably simple topic once you understand it, but a lot of people really have no idea about how things, how things happen in the background, and hopefully this gave you a bit of overview as to what's going on when you hit your button and you send your trade. So, do you guys have any questions at this point? You can type questions here, so let me just, or in the chat room too. So if you want, you can write here. Or else, if you type a question on the question box, then I can answer them, no problem. So answers are here. All right, well, it looks like it was pretty clear. So the other point is, if you guys have any questions on topics that you think we could do a webinar on, by all means, you can email me at juan@darwinx.com, and we'll do our best to produce sessions to explain those. And hopefully over time, we'll have a good bunch of recordings on stuff that can be useful to everybody. and hopefully clarifies most of the most frequently asked questions. If you don't feel like writing those now, that's fine. You can always write to me offline whenever. So I'm always very happy to take feedback from you guys, even when we do something which is not good in your opinion, because those are when we learn the most. So unless any of you guys has any further questions, that would be all from my side. Once again, thank you so much for being part of Darwinex and you know, being part of this journey. It's really exciting to get you guys to beat Wall Street. Okay, well, looks like that's it. Thank you so much. The webinar will be recorded, so for those of you who have arrived a bit late, hopefully the software will get you the recorded version.